All right, let's dive into a real head-scratcher today. I mean, picture this. A company is at the absolute top of its game. They're not just meeting expectations, they're crushing them. They put out a report card that's so good, it's an A++. And then, what happens? The market gives them a big, fat F. We're talking a catastrophic 30% crash. Well, that's exactly what just happened to Micron Technology, and we're going to figure out why. I mean, just take a look at this. It's almost comical. On one side, you've got the report card. Revenue? Nearly $24 billion when Wall Street was only expecting $19 billion. Earnings per share? $12.20, completely destroying the 860 forecast. And get this, they even raised their guidance for the future. I mean, by every metric you can think of, this was a legendary Hall of Fame performance. And on the other side, a stock in total freefall, a collapse of nearly 30% from its peak. It makes absolutely no sense, right? So that's the central mystery we're tackling. How does a report that is, for all intents and purposes, perfect, lead to a complete and total meltdown for the company's stock? Well, to figure this out, we're going to have to put on our detective hats. We're going to piece together the clues, and we have to start at the scene of the crime. All right, before we get to the why, we need to fully understand the what. And to do that, we've got to look at the damage on the stock chart itself. This is where we can see where the key battles were fought, and, more importantly, where the defenses just completely crumbled. $471.34. That was the peak. On March 18th, you had this perfect storm of AI mania, an insane earnings hype, and it pushed Micron's stock to this all-time high. This right here, this is the moment of pure euphoria, the very highest point right before the floor fell out. So remember this number. It's important. Okay, so let's pull back the curtain and see how professional traders look at a move like this. They use a tool called Fibonacci levels. Now, don't let the name scare you. They're basically just important price zones. You can think of them as a kind of roadmap for the stock's price. Now, the most critical one of all is what's called the golden level, the 61.8% line. You see it there at 372.95. For traders, this is the line in the sand. As long as the stock stayed above that price, hey, the uptrend is still healthy. But Micron blew right through it. And that, my friends, wasn't just a small dip. Nope. That was a blaring red alert alarm bell telling everyone that the trend itself was now in serious trouble. So with that golden zone completely shattered, where do we look next? Well, investors are now staring at these final lines of defense. You've got the primary support zone, right around $312 to $315. That's a huge deal because that's the launch pad. That's where this whole massive rally started back in January. If that level can't hold, the next stop is probably the 200-day moving average, which is kind of the ultimate indicator of a stock's long-term health. So really, these are the levels that are going to decide if this is just a brutal correction or the beginning of a much longer, painful downturn. Okay, so the charts are great. They tell us exactly what happened, right? They show us the carnage, but they don't tell us the most important thing, why it happened. That A++ report should have been rocket fuel for the stock. So what was the real catalyst? What was the smoking gun? Well, it turns out it was something that pretty much nobody saw coming. Yeah, in the world of finance, they have a name for this. It's called a black swan. It's that unpredictable, out-of-nowhere event that has massive, severe consequences. And just a few days after Micron's amazing report, Google Research, of all places, unveiled their black swan, an algorithm that was about to flip the entire story for the memory industry completely on its head. It's called TurboQuant, and what it is, in simple terms, is a piece of software. It's an AI compression algorithm that makes large language models, the brains behind AI, just vastly more efficient. And how does it do that? It lets them do so much more with so much less physical memory, or DRAM, which of course is the exact product that Micron sells. And when I say vastly more efficient, I mean it. How much more? 6 times. Just let that sink in. 6x. This little graphic here just illustrates the impact perfectly. With this new algorithm, a piece of software can suddenly make 16 gigabytes of RAM do the exact same work that used to require 96 gigabytes. So literally in an instant, the world needed 6 times less of Micron's core product to get the exact same result. Whoa. And just like that, poof. The entire investment narrative, the whole story everyone was buying into, was completely flipped on its head. I mean, look at the shift. The old reality was super simple. AI has infinite demand, so it needs infinite hardware. Micron will sell every stick of DRAM they can possibly make. But the new reality? Software just became so efficient that we might be staring down a massive hardware glut. You see the problem? All that massive factory spending that Micron was doing suddenly looked like it might be for a world that, well, that no longer exists. So, let's recap. We have the technical breakdown, right? The chart fell apart. And we have the fundamental catalyst, this TurboQuant black swan event. But there's a third crucial piece to this puzzle. And that's the human element. Why were so many investors just so perfectly set up for this trap? To get that, we have to look inside the mind of the investor.
So this whole crash was really built on 4 psychological pillars, 4 mental traps. First, you've got something called the exit liquidity mirage. And that's just using good news as cover to sell. Second, good old confirmation bias. Only listening to the good stuff and ignoring any potential warning signs. Third is recency bias, which is basically assuming that because other AI stocks went nuts, this one would too. And finally, you've got loss aversion and anchoring, which is a fancy way of saying people hate losing money, so they kept buying the stock as it fell, trying to catch a falling knife.
And this quote, this really hits the nail on the head when it comes to that first trap, the exit liquidity mirage. Think about it. When giant institutions want to sell a massive amount of stock, they can't just dump it all at once. They need a huge wave of eager buyers. And what creates that wave better than a glowing A++ earnings report? So while all the retail investors were rushing in, excited to buy on the good news, they were unknowingly providing the perfect exit door for the smart money who could already see that the story was about to change. Okay, so let's get to the verdict. What's the big lesson here? When you put all these pieces together, the technical damage, that TurboQuant black swan, and the psychology of the trap, you get a really powerful and frankly kind of brutal takeaway about how the market actually works. And it really boils down to this: the market's gaze. The investors who got trapped were looking in the rearview mirror. All their focus was on past performance, on that incredible A++ earnings report. But the market is always, and I mean always, looking forward, out the windshield. It couldn't care less about what happened last quarter. It cares about what's going to happen over the next 2 years. And when it looked out that windshield, it saw TurboQuant and the very real possibility that future sales were about to hit a brick wall. And that right there is the ultimate lesson from this whole Micron paradox. An A++ report on what just happened is basically meaningless if the entire story about what's going to happen has fundamentally changed. So it leaves us with this critical question, one we should all ask ourselves. When the story changes, can you see past the numbers?